we continue the incredible stories of the biggest deals in history. Story number 3, the battle for Mannesmann. The events are reconstructed on the basis of the real hostile takeover of the German company Mannesmann by the British Vodafone in 1999 to 2000. Actors: Klaus Esser, CEO of Mannesmann, a proud German industrialist defending his company from foreign invasion. Gent, CEO of Vodafone, an ambitious Brit who dreams of creating a global cell phone giant. Gerhard, Chancellor of Germany, who supports the national interest. Mannesmann's board of directors, the key decision-making body for the sale of the company. British and German media, influencing public opinion and shareholders. Episode 1, the beginning of the attack, the scene of the action. London Vodafone headquarters, fall 1999. Gent stands at the huge window of his office, holding an analytical report. Vodafone is already the UK's largest mobile company, but it needs access to Europe to dominate the world. Mannesmann is key to realizing our goals. Without her, we will not become #1 in the world, he tells his advisor. His plan is to take over the German giant Mannesmann, which controls Germany's cell phone market and parts of Europe. But there's a problem. Klaus Esser, Mannesmann's CEO, is adamantly opposed. In November 1999, Vodafone makes its first offer, $106 billion, and Esser doesn't even consider it. "We are not some street shop to be sold for a piece of paper," he declares at a meeting with the board of directors. But Gent doesn't back down. Episode 2, a national scandal. The scene, Düsseldorf Mannesmann headquarters, December 1999. Vodafone raises its offer to $125 billion. Esser senses that shareholders are beginning to waver. A scandal erupts in German newspapers. German Chancellor Gerhard makes a public statement. Germany must retain its industrial sovereignty. There are rallies in the streets against the English invasion. But Gent is playing big. He speaks directly to Mannesmann's shareholders, bypassing the board of directors. "You'll get money you won't make in a lifetime," he says at a private meeting in London, and 20% of the shareholders agree. Episode 3, Desperate Resistance. January 2000, pressure builds, but Klaus Esser tries to fight back. He proposes a merger with French company Vivendi to strengthen Mannesmann. But Gent doesn't wait, and Vodafone raises the offer to a record $183 billion. Mannesmann's board of directors realizes it is impossible to resist. Shareholder pressure and the huge amount of money force them to reconsider their position. Esser goes to a press conference. "I fought to the end, but the war is lost," he says with a cold expression. Episode 4, Victory and Consequences. February 2000, Vodafone absorbs Mannesmann. It is the biggest merger in the history of global business at the time. Gent becomes the king of telecommunications, creating the largest mobile company in the world. Klaus Esser leaves with $15 million in compensation, and Germany loses its leading mobile company. Epilogue: a few years later, however, Vodafone realizes it overpaid for Mannesmann. The biggest takeover in history didn't turn out to be as profitable as expected. In 2006, the company writes off $50 billion in losses. But the battle for Mannesmann remains one of the loudest corporate wars of the 20th century. Story number 4, the demise of a giant. Our next story is based on the largest and most disastrous merger in business history, the merger of AOL and Time Warner in 2000. Actors: Steve Case, CEO and founder of AOL, an innovator of the digital age who dreamed of creating the media empire of the future. Gerald Levin, CEO of Time Warner, a seasoned media mogul, who believes that teaming up with the rapidly growing AOL is a great future for the media empire. Rupert Murdoch is a competitor and head of News Corp, skeptical of the deal. Time Warner's board of directors is a conservative, old-school business school group that doubts AOL's prospects. AOL's board of directors, young, ambitious proponents of the internet revolution. Investors and shareholders, greedy for the promised billions, but doubtful of the deal. Episode 1, the genesis of the idea. The scene, Virginia AOL headquarters, fall 1999. Steve Case stands at a huge screen on which flickers millions of active AOL users. In the late 90s, AOL is the most powerful internet company in the world. People are connecting via modems, logging onto chat rooms, sending emails. But Case realizes the internet is the future, but AOL needs media power. The idea comes suddenly. What if we merge the internet with traditional media? The goal of the idea: merge AOL with the biggest media empire, Time Warner. He meets with Gerald Levin, a Time Warner executive, and offers him a deal. Levin is intrigued. Traditional media is dying. We need access to the internet audience. If we team up, we'll create something unimaginable. The two giants decide to go for the biggest deal in history. Episode 2, The Triumph of the Deal. January 2000, New York City, Time Warner headquarters. AOL and Time Warner announce a merger. The deal is valued at $165 billion. Shares soar. Analysts predict the birth of a digital empire. Levin and Case speak to the press. This is the greatest merger of traditional and digital media. Levin declares, "We have created a company that will dominate the new millennium," adds Case. But behind the scenes, skepticism is growing. Rupert Murdoch, the media mogul, watches the deal from his News Corp headquarters and smirks. They've made the biggest mistake. In his opinion, AOL is a bubble that's about to burst. Episode 3, The Collapse of Hope. Place and time of action, Wall Street, spring 2000. Everything is going well for the first few months, but suddenly the dot-com crash begins. Internet companies collapse, confidence in AOL plummets. AOL Time Warner stock crashes 50% in a few months. A culture war begins within the company. Old Time Warner bosses despise the internet boys at AOL. AOL folks think conservative media bosses don't understand the future. Case and Levin begin to clash sharply. "We have to focus on the internet," Case demands. "No, our strength is in content and television," insists Levin. Time Warner's board of directors begins to lose faith in the deal. Episode 4, Betrayal and Destruction, Time and Place of Action, 2002, New York. The company suffers a gigantic loss of $99 billion, the largest corporate loss in history. The Time Warner board of directors decides, "The merger has failed. We've got to get rid of AOL." Levin is fired, Case is suspended. In 2009, Time Warner officially breaks the deal and sells AOL for next to nothing. Epilogue, The Legacy of Scandal. AOL dies as a great company, and today it is but a shadow of the past. Time Warner learns from its mistakes and is sold to AT&T in 2018. The deal that was supposed to change the world goes down in history as the biggest merger failure in business history. Our analysis of hostile mergers and acquisitions using the cases of Fox and Disney, RJR Nabisco and KKR, Mannesmann and Vodafone leads to several important conclusions. In the Fox and Disney, Mannesmann and Vodafone, RJR Nabisco and KKR, and AOL and Time Warner merger cases, overpaying for assets and underestimating integration risks led them into long-term financial problems. Underestimating cultural and operational differences led to destruction of synergies and deterioration of business. The loss of key employees and executives undermined the competitive advantages of the deal participants. In all cases, shareholders suffered significant losses due to declining shareholder value and dividends. In addition, debt financing of transactions always requires caution and long-term planning. And the deals done should be solely focused on creating long-term value for shareholders, not short-term gains. These lessons should underscore the importance of strategic planning, careful risk assessment, and a focus on long-term goals in M&A.